Hey there, folks. We all want to build wealth, right? And we all want to find ways to make our money work for us. One of the most powerful ways to do that is through investing in the stock market. Now, I'm not talking about gambling. I'm talking about smart, strategic investing. When you invest in stocks, you're buying a piece of a company, you're betting on its future success, and when that company grows and profits, so does your investment. But here's the thing. How many stocks should you actually own? It's a question that keeps many investors up at night. Don't worry, because today we're going to break it down. We're going to look at different perspectives on portfolio size and help you find the sweet spot for your investments. So buckle up, grab your trading app, and let's get started. Robert Hagstrom, in his book, The Warren Buffett Way, suggests that owning between 10 to 20 stocks is ideal. He argues that this range allows for sufficient diversification while still enabling investors to thoroughly understand each company. Hagstrom's research shows that owning too many stocks can dilute your returns and make it harder to manage your portfolio effectively. So according to Hagstrom, the sweet spot is around 10 to 20 stocks. This balance helps you maximize returns while minimizing risk. Okay, first things first. Why does the number of stocks in your portfolio even matter? Well, it all boils down to two key factors: risk and return. Let's talk about risk. When you put all your eggs in one basket, you're taking on a lot of risk. If that one stock tanks, you're in trouble. But when you diversify your portfolio with multiple stocks across different sectors, you spread out that risk. That way, if one stock stumbles, it won't take your entire portfolio down with it. Now, about returns. You might think that owning more stocks automatically means higher returns, but that's not necessarily true. More stocks can lead to something called diworsification. Yep, you heard that right. Diversification is when you own so many stocks that your returns get diluted. It's like trying to be a jack of all trades, but a master of none. So how do we find the right balance between risk and return? Well, let's hear from the pros. Dave Kansas, a seasoned Wall Street journalist, believes that most investors can't effectively follow more than a dozen stocks at a time. Think about it. To truly understand a company, you need to dig deep into their financials, their industry, their competitors. That takes time and effort. Kansas argues that trying to juggle too many stocks spreads your attention thin. You might miss crucial information or make hasty decisions. You end up reacting to the market instead of making informed choices. Remember, investing isn't about chasing the latest hot stock tip. It's about making smart, calculated decisions based on solid research and a deep understanding of the companies you're investing in. Peter Lynch and the Magic Five. Let's move on to another Wall Street legend, Peter Lynch. This guy knows a thing or two about picking winners, and he's famous for his rule of five. Lynch believes that you only need to find 5 great companies to become financially independent. 5, that's it. Now, before you run off and buy 5 random stocks, let's be clear. Lynch emphasizes quality over quantity. He looks for companies with strong fundamentals, solid management teams, and a competitive edge in their industries. He's not afraid to hold on to these companies for the long haul, letting his winners run and compounding his returns over time. Lynch's philosophy is simple. Find a few exceptional companies, believe in their potential, and let the magic of compounding do its work. The Motley Fool's take on diversification. All right, so we've heard from the Keep It Simple camp. Now let's look at a different perspective. The Motley Fool, a well-known investment advice website, recommends owning at least 12 stocks in your portfolio. They argue that this provides a good balance between diversification and manageability. The Motley Fool's reasoning is pretty straightforward. They believe that 12 stocks are enough to spread your risk across different sectors and industries. This helps to protect your portfolio from sudden downturns in any one particular area. At the same time, 12 stocks are still manageable for the average investor to track and research. So, where does that leave us? We've got Dave Kansas advocating for a dozen stocks, Peter Lynch suggesting a lean 5, Robert Hagstrom recommending from 10 to 20, and the Motley Fool recommending at least 12. Who's right? Well, the truth is, there's no one-size-fits-all answer. The ideal number of stocks for your portfolio depends on your individual risk tolerance, your investment goals, and how much time and effort you're willing to put into researching and managing your investments. But here's Investment IQ Insight's take. For most investors, especially those who are just starting out, we recommend aiming for a portfolio of around 10 to 15 stocks. This strikes a good balance between diversification and focus. You'll be able to spread your risk across different companies and sectors while still having enough time to really understand the businesses you're investing in. Remember, great investing is about having patience. It's about finding great companies with long-term growth potential and holding on to them for the long haul. So do your research, be patient, and watch your wealth grow. If you liked this video, we bet that you will like the 2 videos now appearing on the screen. Go ahead and click on one of them now to continue your investment journey. We'll see you in the next video.